I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no, because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect, which is going to cause the economy to crash. And then you will pivot, not because you want to, but because inflation might be zero, it could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation that's coming down. That's disinflation. It's still coming, you still have inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. And that's a central banker's worst nightmare, because people say, why should I buy anything? I'll just sit in my money and wait for the price to come down, maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. And then unemployment goes up, businesses shut down, stock markets crash, et cetera. And the Fed pretty quickly turns around and cuts rates. Now, we've actually seen this movie, and it wasn't that long ago. Go back to 2015, December 2015. That was the famous liftoff. Remember, interest rates had been at zero, I believe, for six and a half years at that point, the zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And actually, it was longer than that, because they were at zero for 6 years, but there was a series of cuts to get to zero. So the last time they had raised rates was even further back. That was like 2006. So that was more like 9 years. So she raises interest rates 25 basis points, and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more, almost as if they would have been embarrassed if they had done nothing in all of 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was like kind of nothing burger for a year and a half. But then Powell's like boom, 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 25 basis point hikes, and got the rate all the way up to 2.5, which doesn't sound like a lot, but considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean, the Dow Jones, the S&P, and the NASDAQ all fell about 20%, just short of a bear market. It was like 19.8%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are and how behind the curve they are. So the last rate hike was December 14th or 15th. They got to look at the calendar. It was right around the middle of December, 14th or 15th. Even after 2 months of crashing stock prices, they raised rates one last time. They just kept going, and kind of what we were talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre, the NASDAQ fell 3% in one day. The Dow was like about 1.8%, S&P was over 2%, and the NASDAQ was 3%. And then the Fed got religion, like, oh, we went too far. We're the last to know, as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means, patient means we're not going to raise rates unless we tell you. So they were on pause. And then by late 2019, they cut rates. And then along came COVID. And by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.25, 2.5 in Dec 2018, back down to zero by March 2020. Like, what was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected, and they raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie, which is, okay, the Feds, they got the gumption, they raise rates. Now they're much higher than they were in 2018, but they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's tons of negative data. It's not the kind of thing that doesn't make the headlines the way CPI does, but it's all there. It's hard data. So it looks like a bigger, better version of what happened in 2018. And I would expect a worse outcome. So my point is the Fed may in fact cut rates sooner than Wall Street expects, sooner than Michael Wilson expects, but not for good reasons, but for very bad reasons, because we're in a severe recession. So the bottom line is we've had the supply side inflation. Now, we have not seen it come from the demand side, but let's say you're the Fed, okay? All you want to do is get inflation under control. You kind of don't care where it's coming from. You just want to get it down to 2%. So then the question is, okay, how is the Fed doing at getting inflation to the target? The 2% we talked about, and explain why that's their number. The answer is they're making progress, but they're not there yet. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know we'll probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so, in other words, too bad, Well, the Fed has no tools to affect the supply side. The Fed doesn't drive trucks. They don't drill for oil. They don't plant crops. They don't run tractors. They don't do anything that could alleviate the supply side problems. All the Fed can do is destroy demand, and that they can do. When you raise interest rates enough, mortgage rates go up, credit card rates go up, costs of working capital go up. All that tends to slow the economy, and it causes people to tighten their belts. But just think of the conundrum. The inflation is coming from the supply side. The Fed can't do anything about the supply side, but they can crush demand, which should reduce inflation. But how much do you have to crush demand when that's not the problem? It's coming from the supply side. How much demand do you have to destroy to actually affect the supply side? The answer is a lot. And this is what Jay Powell has been saying. Unemployment has to go up. We're going to be in a recession. We got to crush this thing before it gets out of control. And you got to crush it even more, because that's not even where the inflation is coming from. It's coming from the supply side. Supply chain bottlenecks have been alleviated to some extent, not completely by any means. And it was always a case of popping up here and there. It's not like you went into a supermarket and all the shelves were bare. It wasn't East Germany in the 1950s, but something would be missing. It could be the peanut butter one day, or the canned goods the next, or spaghetti the week after that. That has alleviated to some extent, not completely. But again, the reason it has been alleviated is a very bad one, which is that demand is down. In other words, the Fed is destroying demand, so people are buying less. So, grocers and retailers and boutiques and suppliers are able to keep more things on the shelf, not because all the logistics problems have been solved, but because the demand is down, because that's what the Fed's doing. So supply chain better, yes, but for good reasons or bad reasons? Well, it's for bad reasons because demand is down. And that's another thing leading us into recession. So a couple of things. We should probably, without taking too much for granted, we should probably just define BRICS. It's an acronym: Brazil, Russia, India, China, South Africa. So those are the BRICS. And started in 2002 as a Goldman Sachs marketing gimmick. Jim O'Neill and some partners came up with it. And all they did, I'm not diminishing what they did, but they kind of took the leading economies, took out the G7 and Switzerland and a couple of obvious leaders, and said, well, who's left? That will be the up-and-comers, the fastest-growing developing economies. Then they got Brazil, Russia, India, and China. That was kind of easy. And then a few years later, they added South Africa, which was a little bit of a favor to South Africa. South Africa is not anywhere near as large as those other economies or as important. However, it is one of the biggest economies in Africa. And if you're going to be the BRICS, you probably can't just be South America and Asia. You probably need to include an African country. So they picked South Africa. So for a couple of years, it was a Goldman marketing brochure. But then in 2006, at the United Nations General Assembly in New York, annual meeting, heads of state and foreign ministers show up from all over the world, but they have what they call these bilateral meetings on the sidelines. And sometimes there are 3 or 4, say, hey, we're all here, let's just grab a conference room and sit down and talk. Well, Brazil, Russia, India, and China, they sat down And they said, "Yeah, we actually have a lot in common, a lot to talk about." And we added up, we're a pretty powerful group. So they formalized it. And then in 2009, they had a summit conference, a formal summit conference with an agenda and all that in Yekaterinburg in Russia, in the Russian Federation. And they solidified, okay, we're a group, we're going to work together. And they did. And over the coming years, they multiplied numerous. People say it's the BRICS meeting. They have about 190 meetings a year. They have working groups on women's rights, sports, the environment, climate change. It could go on and on. It's a very active, what they call secretariat, which is central organization. A few years later, in 2014, they formed what they call the New Development Bank, NDB. Well, what's the New Development Bank? First of all, it's got 100 billion of capital, part paid in, part callable, but it also has borrowing power with that kind of ownership and that kind of capital on the balance sheet. They've got hundreds of billions of dollars of borrowing power. They could easily get a pretty good credit rating. And the purpose is to make loans for development projects to the member countries. And by the way, there are stockholders of the New Development Bank who are not BRICS, but they're kind of in the club. Well, what does that sound like? The World Bank on their own terms with their own governance. Okay, the following year, they created something called the Contingent Reserve Arrangement. Well, what's that? Again, they threw in a couple $100 billion from the members. China was the biggest contributor. Again, with borrowing power, so take a couple $100 billion times 5 or 10, that's your power. And this institution was designed to be a swing lender to members who were running trade deficits or facing a run on their currency or facing the prospect of having to close the capital account. Exactly what we saw in 1997, 98, by the way. I was there for that one. We ended up with long-term capital. Well, a pool that is a swing lender to countries with balance of payments deficit, what does that sound like? That's the IMF. So basically, they copied the World Bank, they copied the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They're very methodical. So they've duplicated the World Bank. They've duplicated the IMF. Now they have applicants for membership. And there are, I think, 21 or more countries who have applied, well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted, starting with Saudi Arabia. Okay, so what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is, I learned development economics in the 1970s. We had something called the third world. It was Russia or, Soviet Union and the US. And then there was the third world. And all you knew about them was they were poor and, you had to get them off the runway. We actually had the runway theory of how you'd grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military, and again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, this goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics, some, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, led by China. And these are mostly Central Asian republics, including Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China China's a member of two. Russia's the only country in the world that's a member of all three. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this thing plays out, I'll talk about the thing, I realize we're glossing over that, but when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget, it's a map of the world that's blank, and you can go country by country and fill in by color, just click on it and give it a color. And I did that. And I was like, okay, here's the BRICS, it's 5 countries or whatever. Well, here are the applicants, it has another 20. And here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going. And all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island, what he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is more collective economic and population power? By the way, output of wheat, pick your metric. This dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Let's just kind of digress for a second. And what are the headlines saying? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? And Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Now, Russia sells oil to China. China pays in BRICS, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem. If you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Euro-dollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards, they stop doing loans, and then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over tightened, and they may pivot to say that there could be a rate cut. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. The definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are 2 different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying no. You're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed, because you have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing. And that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today, because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices, because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, Biden, they're all a big deal. If in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, because everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And I use, as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. And we know that the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. There's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
Yeah, I'm not alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time ×3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, the stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down the S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad. You'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a whatever, a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. That was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the situation we're in today is very different from the 1970s, and I'll explain why. But I'll explain why right now, because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value." The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had, they didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and we'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped out on the credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall, increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation's not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else. Go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So Treasury notes, a good 2-year note, a 5-year note, will perform very well. And they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%. Not quite 5.5%, but well, between 5.25% and 5.5% for 6 month for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. What it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do, but how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. Well, globalization is dead. I mean, it should have died a long time ago. But this period of globalization we lived through between I'd make it 1989 to 2010 or thereabouts. It was the second age of globalization. The first age of globalization was 1870 to 1914. And there was free trade, and bankers in London were selling bonds to investors in New York on Argentine credit, and letters of credit were moving. There was trade moving all over the world, and that it kind of resembled the late 20th century. And then it hit a brick wall at 70 miles an hour called World War I. And the New York Stock Exchange was closed for 5 months between August and December 1914. And as were most major stock exchanges around the world, and the gold standard ended immediately. People went through the pretense of having gold. What they did is they hoarded the physical gold and just printed money. So that ended, and then you know the rest. Hyperinflation in the early 20s, depression in the 1930s, World War II, Cold War. And it wasn't until the fall of communism in stages between 1989 and 1991 that we got back to globalization. But it was the second time. The first time was real. The second time was a fraud. You had people like Jeffrey Sachs at Columbia and Richard Haas at the Council on Foreign Relations and a lot of others promoting this. But what it really was an enormous theft from the United States of financial capital, intellectual property, et cetera, for the benefit of China, and I like to say that, you know, the only thing worse than a poor communist is a rich communist. So what we did is we created a lot of rich communists, and here we are. But no, the globalization is dead. It's been completely discredited. Tom Friedman and Richard Haas and Sachs and the rest can go off and write their papers, but the real world has moved on. And by the way, what she was describing goes back to antiquity, and there was explicit biblical references, but even earlier in Babylonian kingdoms, it's called a jubilee. And the idea at least in the Bible, in the book of Leviticus, every 50 years, all the debts would be forgiven, because they knew that people overborrowed. They knew that people lended recklessly. They knew that the system was overburdened by debt. This is all very clear. And they said, well, every 50 years we're wiping out the debt. And so you say, well, wait a second, isn't that a little unfair to the creditors, the lenders, you know? But the point is, the lenders weren't dopes. So after the Jubilee, in the first year of a new expansion, I would be very comfortable making a 5-year loan, you know, secured by land. But when you get to year 40, in a 50-year cycle, knowing what's coming, you're not going to make a 10-year loan in year 40. You'll probably make a 1-year loan, and by year 45, you know, you're not making any loans. But here's the point, and this really gets into the physics of it. The system, with foresight, knowing the rules, voluntarily deleveraged itself in stages, so that the Jubilee was not a train wreck. It was like there wasn't that much debt around because people saw it coming. And so what you were really doing was setting the thermostat in such a way that it would be self-regulating. And
right.
I'm sure some.
Whereas what we've done is the opposite. We've taken the brakes off the train.
That's because we got rid of the Jubilee concept. Now we have something better than a Jubilee that Pippa did not mention, and it is. Look, everyone else can default on their debt, including their dollar-denominated debt if they're in emerging markets, et cetera. And you have Argentinian train wrecks all over the place, and she's right about that. But it all comes back to the United States. How does the United States default? There is no reason for us to default because we can print the money. The way the U.S. defaults is inflation. And in other words,
I agree.
Even modest inflation, 3% inflation for 18 years cuts the value of the dollar in half. Which means the real value of the debt goes down by half. And by the way, we did this. In 1945, the U.S. debt to GDP ratio was 120%, the highest in history. And I like to say, yeah, but at least we won the war, you know, along with our allies. So we got something for it. We were we had 50% of the world economy. But between 1945 and 1980, the debt to GDP ratio declined from 120% to 30%. When Ronald Reagan was sworn in, the debt to GDP ratio was 30%. And he was the first of the big spenders, and it's been going up ever since. Today, we're back to the World War II levels. But how did we do that? We did it with a couple of things, what's called financial dominance, which has been explained by Rick Michigan, where basically the Fed is the handmaiden of the Treasury, and they keep rates low. And all you need is negative real rates. Basically, if inflation is just slightly higher than the nominal rate. So we had nominal rates of 2-3% through most of the 50s and early 60s, but inflation was just a little higher than that, which meant that it was like an ice cube melting in your hand. It wasn't abrupt. It wasn't like blatant theft like FDR did when he confiscated the gold in 1933, although he gave you $20 in paper monies to not violate the Fifth Amendment. But the point is, that's how you do it. Now, here's the dilemma. The Fed has been trying to engineer this for 12 years, and they failed. I like to say it's a sad day when a central bank wants inflation and can't get it. And everything we talked about, including all the employees that my hypothetical restaurant does not hire back, and all the, I forget which presidential candidate said, well, who cares if manufacturers get laid off? We can teach them to code. Good luck. There's no evidence that people in midlife, mid-career with one skill set, which could be valuable, can somehow retool themselves and become coders, and that's probably a good thing, but they can't do it. There's no evidence for that. So how do you get out of this embedded high unemployment, embedded deflationary psychology, classic liquidity trap? You know, name your, put out your descriptor. They all apply. How do you get out of that? The answer is inflation. But how do you get inflation when the inflationary psychology is so bad? It has been done twice, and I could do it in 15 minutes, and I explain this in a couple of my books. You call an emergency meeting at the Federal Reserve Board. You go in the room, you close the door, you take a vote, you come out, you walk up to the microphone, you say, ladies and gentlemen, as of today, the price of gold is $5,000 per ounce. If you think that's cheap, come and get it. We got a lot in Fort Knox. If you think that's expensive, serve it up. We'll pay you for it. And we got the printing press. And if you use the gold in Fort Knox and West Point, that's where most of the gold is. If you use the gold, the physical gold in storage and the printing press to conduct basically an open market operation in gold, this is how we peg interest rates. We buy securities with printed money and we sell them back and make the money disappear. But if you use the printing press and the physical gold to maintain say $5,000 per ounce price of gold, it's not to enrich gold investors. It's to get the price of everything else up. And FDR did this when he took, in the greatest period of sustained inflation in U.S. history from 1927 to 1933, the price of gold went up 75%, from roughly $20 an ounce to $35 an ounce. Why was that? Well, FDR did it. The government made it happen on a kind of gold standard at the time. But what he was really doing, this is what people don't understand. When the price of gold goes up 75%, nothing really happened to gold. It's atomic number 79. It's a metal. What happened was the dollar was devalued by 80%, and the price of everything else went up. FDR wanted the price of oil, corn, wheat, copper, everything to go up, and it did. 1933 was one of the greatest years in the history of the stock market because he bent the curve on deflation. Richard Nixon did the same thing by accident. Richard Nixon wasn't trying to do it the way FDR did, but he did it anyway by suspending the redemption of dollars into gold in 1971. But what happened by 1980? I mean, I took out my first mortgage loan in 1980. It was 13%. My poor mother cried. Her first mortgage was like 2%. But I said, Mom, inflation's 15%. So my pre-tax rate is -2. That's cheap money. That's better than free money. And we had 50% taxes in New York at the time. So my after-tax real rate was -7. So they were paying me a lot to be a borrower. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth, or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. So the way it works is raise interest rates, tighten money, reduce the balance sheet, et cetera. Get unemployment up. It doesn't sound like a desirable goal, but that's what it takes. And that's what happened in 1982. Get unemployment high enough so people are buying hamburger instead of steak. They're buying, whatever's the least expensive thing on the shelf, day-old bread instead of new bread, or they're not buying gasoline because they're not going to work, et cetera. That will bring prices down, but at a very high cost, which we just talked about, which is high unemployment and lower productivity. Meanwhile, the U.S. debt keeps going up. We haven't really talked about the debt. That part of it looks like 1981. But if you throw in a global financial crisis, then it starts to look more like 2008. Yeah, well, that's like a glacier. Glaciers are extremely powerful, but they move extremely slowly. There's some exceptions, but they kind of like, an inch a year, a couple inches a year, but they move mountains. I mean, they create rivers, they create canyons, they move mountains. They're extremely powerful, but slow. That's a good metaphor for the impact of debt. And when I talk about debt, in particular with the United States, but it applies to any country, I focus on the debt to GDP ratio, because you can't really talk about debt in isolation without thinking about the capacity to pay the debt. And a simple example, if you have a $50,000 balance on your credit card and you're making $30,000 a year and trying to pay rent in New York, et cetera, good luck. You're probably going to go bankrupt or at least default on that card. But if you owe $50,000 on your credit card, but you're making $5 million a year, it's, you just write a check. It's no big deal. My point is, you can't look at a $50,000 debt and decide if it's a problem or not unless you compare it to the income. And if it's too low, it's a problem. And if the income's high, not a problem. So that's why you use the debt to GDP ratio. The US just hit $31 trillion in national debt. That is national debt, almost all of it in the form of US Treasury securities. Not all of it, there are other obligations, but mostly US Treasury securities. Well, is that a problem or not? Well, one way to answer the question is compare it to GDP, do the ratio. The answer is that ratio is now a little over 130%. What was it in 1980 when Ronald Reagan was elected? The answer is 30%. 30% is completely comfortable. That's like the person with the $50,000 debt is making millions. No big deal. 30% is comfortable. 50%, yeah, getting up there. Angela Merkel and all her years in Germany, and there's a lot of research to back this up, says that 60% was the limit. And that's what the Maastricht Treaty that created the European Union and the European Central Bank, that was their goal. They said, don't go over 60%. If you do, you're expected to take measures, raise taxes or reduce debt or reduce spending, do something to get that back down under 60%. If you say, what's the critical threshold where, water turns to steam, or, water turns to ice, or something changes in such a way that it's not the same. It's radically different, but it happens very quickly. The best research says the answer is 90%. And this comes out of, Ken Rogoff at Harvard, also Carmen Reinhart, who's now the chief economist at the World Bank. But they've looked at hundreds of cases over hundreds of years. And I like that because it's not just, kind of cherry picking data. Developed economies, developing economies, economies that issue debt in their own currencies, ones that issue debt in other currencies, principally US dollars, et cetera. So, a wide variety of case studies. And they show that when your debt to GDP ratio goes over 90%, your multiplier of additional debt goes below 1. So just to put that in context, at 30%, if I borrow $1 and spend $1, I might get $1.30 of growth. Assuming you spend it wisely, that's a big condition. But you borrow $1 and spend $1 and get $1.30 of growth. Okay, the debt was productive if you put it to good use. But that $1.30 gets smaller and smaller. As you get closer to 90%, it goes to $1.20, $1.10, $1.05. Past 90%, roughly, you borrow $1 and you spend $1 and you only get 95 cents of growth. You don't get your dollar back in terms of GDP. And then 90% and 85%, et cetera. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth, or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. Now, Stephanie Kelton, she's the big brain of modern monetary theory. She's a professor at State University of New York. She says it doesn't matter. That they always point to Japan. Japan is at 280%, way past any member of the peer group. China's probably higher. China's a little more opaque because they are, but also they don't have as much national debt. If you look at the national debt to GDP, it's modest, but they have an enormous amount of provincial debt, and the banking system is owned by the government or controlled by the government. So when you throw in the bank debt, the state-owned enterprises, the provincial debt, and the government. So that's the real national debt. Stephanie Kelton says it doesn't matter because you're borrowing in your own currency. So if you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have huge trade surpluses, which they don't? So they just default. Argentina is a serial defaulter, and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about the foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. I mean, if it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of US Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. And they're just not very knowledgeable about any of those things. But you can think of exchange rates as a conveyor belt. Exchange rates are one way the problems go from one country to another, or good things can go from one country to another, depending on whether your exchange rate is going up or down, the impact on terms of trade, et cetera. But they completely ignore all that. They also ignore the role of commercial banks. They just look at the Treasury and the Fed and look at money supply, but like kind of M0, but don't understand how commercial banks create M1, and they do their own thing. They're not on as short a leash as they seem to think. But if you read Stephanie Kelton's book, The Deficit Myth, she says, well, we don't really need a bond market, U.S. bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. But why have, he said, you have government spending. So the Treasury borrows money by issuing bonds, and then the Fed monetizes the bonds by buying the bonds, and that gives the Treasury the money to pay the bills, et cetera. She says, do away with all that. Just give the Fed, wire instructions for Lockheed. And if you need 5 F-35 fighter jets, order them and just send the money right to Lockheed. Why do you need a bond market? I mean, she actually says that. So, okay, legally, that might be possible, but to suggest that you can do that without consequences is nonsense. And then you say, what about inflation? Their view is as long as there's excess capacity and unmet needs, et cetera, you're not going to have inflation because there's a lot of slack in the economy. That's a legitimate debate. But they say when inflation happens, raise taxes. And then, by the way, they also say you don't need a tax system, because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. But it's important to bear in mind that Stephanie was the principal economic advisor to Bernie Sanders in 2016 and 2020. And Bernie Sanders today is the chairman of the Senate Budget Committee, controls the purse strings. So coming out of Congress, and Biden's kind of a cipher. He's barely aware of his own existence. So Sanders is in a powerful position, and she's the Bernie whisperer, so to speak, who's behind all this. So if you ask the typical member of Congress, can you define modern monetary theory? They'll look at you funny. They've either never heard of it, or they certainly don't know what it means, MMT, But they're acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior of the Congress, and again, just go back to COVID 2020, because we talked about the debt to GDP ratio. So in around May or June 2020, Trump put through a $2 trillion COVID relief package, and that was when the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check, et cetera, et cetera. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion almost, and that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. That's what the Fed does is kind of nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone, he did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, they did the $1 trillion infrastructure package. And then, just to top it off, what did we get recently was the just under $1 trillion Green New Deal. I call it the Green New Scam. Well, and the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, and 2022. Add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says doesn't matter. but it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress.